Oh, we're live. Okay. Hi, I'm Leah Wald, and I'm here with Tyler, and we have missed you guys a lot. Oh, I think, nope, we're good. Tyler's being very silly today. Just going to warn everybody. I'm always silly. Tyler's silly too, but like abnormally so. But yeah, it's fun to be back. This one's going to be a fun one. I'll let Tyler explain, but it's going to be a bit of a fireside chat. And since we have missed you guys for a couple weeks now, pretty much going to try to answer the plethora of questions synthesized into a couple, but I'll just turn it over to the silly guy, Ty.
Thank you, Leah, and welcome back, everybody. A brief apology. We've tried to keep up on Twitter every day, or at least when there was something we thought was important to talk about. But we have been remiss in terms of doing vlogs. That was purposeful. We are reorganizing a bunch of the things that we are doing having to do with various corporations that we have put together in order to be much more efficient in handling our growing number of followers. We've only been doing this a very short period of time now, about 4 months. And we're very thankful for the support that we've been given by the community, particularly people like Tone and Vortec and Jimmy and Giacomo. And Leah's done a spectacular job intertwining what Hyperwave is about and what the ecosystem is about. And in all of that, all of a sudden we find ourselves every time we do a vlog with 3, 4, 5, 6, 8, 10,000 views of it, which means a lot of people have a lot of questions and a lot of comments. And so we've reorganized some things. We are now reorganized. And from now on, you will hear us on a very regular basis. I would like to promise once a day and sometimes twice a day. I can't make that promise just because things come up, but we're going to certainly try to keep to that because there's so much ground to cover. We don't just talk about cryptos, obviously. We don't just talk about Bitcoin, although that is the major focus that we got into when we noticed that this thing called Bitcoin was in this thing called a hyperwave. And since no one else knew what a hyperwave was, we thought that would be a great entree into demonstrating a very powerful tool that then could be broadened out across all asset classes and all investment vehicles. And you've heard us talk about a very diverse set of subjects, such as retirement accounts, and such as traditional markets, and such as the fundamentals behind the technicals, such as macroeconomics having to do with interest rates, central banks, U.S. Treasury policy, and how that all fits together. Now, if you have heard a half of our vlogs, that means you didn't hear the other half. If you've only heard 2 or 3 or 4 or 5 or 10 of them, that means that you've only got a 10 or 15 or 20% of all the subjects that we've talked about. So what we're going to try to do is we are going to try to summarize some of what I think of as the little gems or the little treasure boxes that we've been able to distill out of all of these various subjects and try to make it as clear as we can from our perspective. Now, remember, our perspective is very different from what you get on almost all the other YouTube vlogs or the Steam vlogs or the Reddit information, or even things like Medium or Twitter, because what we are trying to do is to get people that have no experience in investments except in cryptocurrencies to understand that there are things you need to know that you can bring into the cryptocurrency space that will help you to reduce your risk and increase your profitability from traditional money management concepts. So this is just going to be a free-flowing discussion between Leah and myself, where I will attempt to distill in as precise a way as I am capable of, given the experience that I have, all the mistakes that I have made, all of the victories that I have seen, not only by myself, but many, many, many other professionals over a very long time period. Well, you're right in thinking, oh my gosh, this is going to take 10 hours. And after 10 hours, you would still only have a modicum of the information that you need. But I'm hoping by doing this tonight, and we will do it in part 2 and part 3 and part 4, we can tie some of these disparate concepts together. Now, why am I doing that? Basically, because of the questions and comments we're getting from you. We're getting an awful lot of very intelligent, very incisive questions that have been posed, which means that we have not adequately answered them, or we've glossed over them because we need to get to another subject. So enough of the introduction. Let's just start with the topic. And the topic tonight is how you should be thinking of your investments. And there's a lot of very important terms in that sentence, but the two that I want to talk about is thinking and investments. Very often what we do when thinking about our money, and what does that mean? Well, it's pretty simple. If you take all of your assets and subtract all of your liabilities, what is left over is your money. And that means everything from the long-term stuff that's very illiquid, like real estate, where you have a mortgage and you believe that your asset is worth $200,000 and you know that your mortgage is $100,000. Basically, that generally means you have $100,000 in equity. So take that $100,000 and put it to the side. That's going to be the building block of your wealth. You should have some sort of retirement accounts, and please go back and listen again to our vlog on retirement accounts. If you do not, you should. It doesn't matter how old you are. We've got a number of people that are 60 years old or more that have written to us after hearing that, and they said, you've convinced us. We've gone ahead and set up the first retirement accounts we've ever had. And that means you start slowly with an IRA. You can put $5,500 in. You can put up to $18,000 into a 401k. You can't be in a 401k unless you're part of a company that offers it. And there's all kinds of details. We're not going to go into details. So the first thing was the real estate. The second thing is your retirement account. The third thing is any investment accounts you have. That means that Fidelity or Schwab or Pershing or E-Trade, where you've been playing around or you've been investing, you've been studying it, you've been making decisions, and there's something in that, let's call it X. It doesn't matter if it's $100 or if it's $10 million, it's X. Now you've got your real estate, your retirement accounts, and you've got some extra money that you've decided you don't want sitting in a bank and you would like it to grow in some way. So you've opened up what is an investment account. And after you've done that, you've got a bunch of things that are basically not wealth. There are things you like to have, like furniture and maybe some paintings and maybe some other things, some books you've collected, things you've collected. All of those things are not liquid. They probably are not investments. And I'll get into that in just a minute. But it is part of your wealth. It's part of the thing that you and a spouse or you and a family have put together over a period of time. And if you add all those things together, it goes up and down. But if you just take this very simple approach, which is all of the assets you have, insurance policies, money that you might have inherited, money that you're hoping to inherit, a business you might have that very often has very little equity in it because it's so difficult to get a business off the ground. But if you spend a lot of time, maybe you've actually got some equity in it in which you can consider that as wealth. And I don't mean playing games with taxes and playing games with what it's really worth. I mean, if you go to a third party and you have them evaluate it and they come back and they say, I will give you X for that, then X is what it is really worth. It's only what you can change it for. Okay, so you go through all of those things. Excuse me, my popsicle is melting. You go through all of those things. It was getting all over my foot. You go through all of those things and you subtract from that number what you owe. You know, what you owe on your car, what you owe on your house, what you have on your credit cards. And be realistic about that. That's Y. Subtract Y from X, and that is your wealth. Your assets minus your liabilities is what you have. Now the question is, we haven't talked about investments at this point. In my mind, there are only 3 asset classes that I consider to be investments. And those are stocks, bonds, and cash. And the reason for that, and I'll explain that in a little bit more, is they're the only things you have that are what is called liquid. Liquid, liquid. That means that you can turn it back into fiat very quickly. You should be able to do it within 24 hours. Once you get beyond 24 hours, it's no longer liquid. But if you're talking about real estate, it's not liquid at all. It takes months and months and months and months and months usually to get out of it. And you never get what you think you're going to. And almost all other investments that aren't stocks, bonds, or cash fall into that category. Now, I'm not saying you can't make money. That's different. You can make a lot of money, probably more money in real estate than anything else. The only thing you can make more money in terms of increasing your wealth is owning your own company or having a profit sharing plan in a company that is growing. That's where you hit the home runs. That's where the big, big dollars are made. Those are not investments and they are not liquid in my vernacular. Okay, so stocks, bonds, and cash. Stocks, bonds, and cash. Stocks, bonds, and cash. So you take your total wealth, and let's put some numbers on it. Let's say it's $100,000. If you pay off all your bills, sell everything you've got, you're left with a stack of $100 bills that equals $100,000, and there's nothing else you've got. That's it. Okay, that number could be $1 million or $10 million, or it could be $100, or it could be a negative number. And one of the difficult things of this medium, meaning Twitter, YouTube, is y'all get to know Leah and myself intimately. And we don't get to know any of you at all. So I know I am speaking with 12-year-olds, 15-year-olds, 20-year-olds, 30s, 40s, 50s, 60s, 70s, and 80s. I know I'm talking to very wealthy people, and that wealth came from all of those things I just mentioned. I know that many of you are not very wealthy, and that is a relative term. No matter how much money you have, you've got a whole lot more than the majority of people in the world, even if it's $100 in total wealth. If you've got $100,000, there's a whole lot of people that have a whole lot more. If you've got $10 million, there's a whole lot of people that have a whole lot more. We are not talking about the absolute levels of wealth. We're simply talking about that simple formula of X minus Y equals wealth. I'm really irritated that that melted. Okay. All right. Now, why do I go through all of that? Because you are all hearing different things every time we vlog. You're hearing it from your personal perspective. Now, if you happen to have come onto this Hyperwave channel because we were talking about Bitcoin and this funny, goofy thing called a hyperwave, that's what brought you to the channel. So that puts you into a certain group of people that are very different than everyone else that has come to me over the last 40 years before there were things such as cryptocurrencies or Bitcoin. So that's a weird setup. In other words, the 6,000 people that are now following us have come to us, and many of them would never have done that if this had been 5, 8, or 10 years ago, because this asset class wasn't around. Now, many, many, many people in the crypto ecosystem, how do I put this delicately? Many of the people are very inexperienced at investments. Certainly not all of them. Certainly there's a bunch of people that have gotten into crypto after having tremendous backgrounds in technical analysis, fundamental analysis, investment analysis, portfolio management. What we find interesting, Leah and I, and we talk about it all the time, is the demographics of the people that listen into this channel compared to the demographics that we can find on YouTube of people that are listening to other people talking technical analysis and Bitcoin and cryptocurrencies. The age of our listeners tends to be twice that of the other people. And I think a lot of that has to do with the recognition that we're talking about a much bigger concept than this one asset class, even when we talk about this asset class. When I talk about hyperwave, it's not because I came up with this thing called hyperwave for Bitcoin. It's that I came up with it 40 years ago, and I've used it in the Japanese stock market, in the US bond market, US stock market, in the gold market, in the silver market, asset classes that were already set up. So the comments you hear me making when applied to this new asset class usually rings differently for two groups of people. Those that don't have the background in all those other markets and only have a background in crypto, and those that do have a background and find an interesting set of observations that we're making about Bitcoin and crypto that rings true because they've seen it work in other markets. Not hyperwave, I mean technical analysis or fundamental analysis, money management, risk management, risk versus reward, when to get in, when to get out, how big the position sizes should be, all of that kind of stuff. you've either been exposed to it before or you haven't been. And my point right now is that many of the people that are in this space, this is the only space they've been in. And they're criticized for it as being too young, too naive, too idealistic, and on and on and on and on. And I don't really buy into any of that, because anytime a 17 or an 18-year-old comes into my office off the street and says, you know, they just had this inheritance and they'd like to talk about what to do about it, that's in the same position. I assume that they don't have the background in what it is going to take to do something intelligent with that money. Same thing in the crypto space. I can't assume that simply because somebody got in early and made $1 million, that they made $1 million for any other reason than they happened to be in the right place at the right time with the right idea, which is wonderful. You know, congratulations. But that's a very different thing. Winning a lottery ticket is a very different thing. I've had 3 different people over the last 30 years that have won lottery tickets ranging from $5 million to $25 million that have been sent to me to try to help them. For a while, the company I was with sponsored the New York Jets. And one of the things I did is I would sit down with the rookies and talk to them about money management. Because here are very young people that are on the cusp of making enormous amounts of money, very often with not enough education to understand any sort of perspective about that money, and very often making a lot of horrible mistakes, which often happens in athletics. So the Jets management thought it would be smart right from the beginning to begin talking the kind of things I'm talking about tonight. So we're not talking about intelligence. We're not talking about age. We're not talking about knowledge. We're not talking about iconoclastic beliefs in political or economic systems. We're not talking about pro-government or anti-government, but people in the space are. And because of all of that, what the tendency is to assume that you know more than you really do about what is happening with the price of this particular asset class. Okay, so that's part 2 of the introduction. Just a broad sweeping view from somebody that has worked with thousands of clients and billions of dollars under a very wide spectrum of guidelines. Guidelines meaning what somebody expects when they want to have comments made about their money and what to do with it. Some of it's very formalized, and that's what fiduciary responsibility in the pension world, what is called ERISA accounts, retirement accounts, defined benefit accounts, defined contribution accounts, 401ks, IRAs, all of those sort of things. All of the government workers are in programs that are basically pension funds. All municipal workers, all teachers, all major corporations. And in order to do that properly, you are given, you meaning a person having to make decisions about what to do with the money, very, very specific guidelines of what you can do, you can't do, you should do, you shouldn't do, and on and on and on and on. Here, in this particular brand new asset class, there are no rules. There is no barrier to entry. Right up through today, there are no regulatory requirements keeping anybody from doing anything they want. And because of that, a lot of very bad habits can easily be formed mentally, emotionally, and most importantly, financially. And it does not need to be that way. And that's one of the things that Leah and I, before we even started, discussed about what we want to try to accomplish. And the demographics to us are showing that it's beginning to ring true with a lot of people, which is one of the reasons we've spent the last 2 weeks sort of reorganizing on a professional basis what and how we do it. And we'll tell you more about that later. Okay, let's get back to the most important concept: cash, stocks, and bonds. Why in the world do I separate those out from everything else? Let's call them, let's start with collectibles. And collectibles run the gamut. I happen to be an expert in numismatics, rare coins, and I've dealt with them my entire life. And they can be very good investments over very long periods of time, but in almost all cases, they are not. And unless you really, really, really study it, they never are. You will be taken to the cleaners every time you get into it, for a number of reasons, and we won't go into that now, maybe at some other time. You can do things like you can invest in racehorses, thoroughbred racehorses, quarter horses, Arabians, and a lot of people look at that as an investment. But believe me, you have to know so much about that area. I'll just throw out, general numbers here. Don't hold me to any of these, other than that I've done a lot of the things in that area also. But 9 out of 10 people that invest in things like horses lose a lot of money. A very, very small group of people make a huge amount of money, and they are very wired, and they are very connected, and they know exactly what they're doing and how they're doing it. And it's taken them a lifetime to get there, and they made a lot of mistakes along the way. Things like Chinese ceramics or ceramics. Behind me, you might see this little vase thing. That's a Han Dynasty vase. It's 2,000 years old. My family, my sister, was in the business of bringing Chinese antiquities into the United States for the last 20 years. And so I learned quite a bit about it. I've been to a lot of auctions. And again, you must be, and very, very few people are, experts. You've got to study it, the history and all the details about it, and which ones are not really what they purport to be, and how you can test them to see if they really are what they are. Same thing with rare coins. One of the things about rare coins is that they are so easy to counterfeit, just like bills are today. So there are very few places. You can talk about Oriental rugs. You can go into a place and hear what they say about how old it is, and this one sold at an auction for X, and all of this sort of stuff. But unless you really, really know it, 9 out of 10, maybe 90 out of 100 people that put money into those things will never get that money out. They're beautiful, they're interesting, they've got history to them, but they are not investments unless you make it your life work and know more about it than anyone else, or just about anyone else. And we can go on and on, all the way down to the Franklin Mint, and to Yadro, and to little ceramic things and fun, beautiful things, and Beanie Babies and pet rocks, and on and on and on and on, where people for a period of time will believe, oh, wow, this is going to be a great investment. I'm going to make a lot of money. The reason I keep talking about stocks, bonds, and cash, and it doesn't matter, that's worldwide, is because they are so liquid, the pricing of them tends to be true. True meaning within a very small degree of error, because it's decided by millions of people, millions of experts and millions of non-experts. by voting in terms of buying or selling them. And that shows up in a chart, and it shows up in the same way for everybody that's looking at them, which means that you can value what you have done by putting fiat money into those things. And you can make the decision when to pull out of those things and get back into fiat money without finding that you just lost 10 or 20 or 30 or 50 or 90% of what you thought was your wealth. And there's almost nothing else you can do that with. Okay. So now let's get back to stocks, bonds, and cash. I'm not talking about stock certificates like Tesla stock. I'm talking about all stocks. And all a stock is ownership in a corporation, period. So when you buy stock in General Motors or IBM or Tesla, you own a piece of that company. But it's in the form of something that is very liquid, a piece of paper that anyone can buy from you minutes later on an exchange. And you and that other person know within usually pennies of the differential between what you're buying and selling it for, which makes it something that you can count on in terms of our original statement about wealth. What are you really worth? What do you really have? As opposed, what would you like to have? What do you believe you will have 5 years from now, 10 years from now, etc.? I'm almost ready to add a fourth to that stocks, bonds, and cash, which is Bitcoin. But I can't. It has not qualified for what I just described. Not because it doesn't have all the ability to do that. I think it does and more. But because the infrastructure behind it is so flawed in terms of the exchanges, the wallets, the security, the movement from one place to another, and the ability for third parties to throw a hand grenade into what you assumed to be yours. Now, I think we are getting to the point where maybe some changes will be forced upon the ecosystem. And I refer you to Leah's brilliant article on Medium that just came out. If you haven't read it, please do, because it gives a perspective. The other thing you should be all doing is listening to the news report, the morning brief by Tone and Jimmy and Giacomo and Leah every morning, because that's the way to keep on top of the ecosystem without listening to one thing or reading one thing and then 2 weeks later hearing something else and having a friend or somebody else tell you something or you stumbling across something. This is every single day the most recent information about how the ecosystem is either progressing or digressing. And unfortunately, in my opinion, most of what we have seen over the last 6 months is a digression away from what was beginning to look like it was a real ecosystem developing. And we're not going to go into that tonight. Now, I've said over and over again that I do not buy cryptocurrencies. I do not buy Bitcoin, even when Bitcoin's going up, because it, to me, is not liquid. And there are too many potholes getting from your fiat money in your bank or on a credit card to a series of numbers in some theoretical wallet that theoretically might be safe and theoretically might not be hackable until the next news item comes out where it was just hacked. So the only way I am personally or putting clients into this ecosystem is through the only security available, which is GBTC. And I'm not going to put very much money in that because it is not really Bitcoin. And it's got all the quirks that Leah and I've talked about. We did a whole show on it, and we will do more on it. But at some point, this ecosystem is going to mature, and a lot of the noise is going to go away. And then I will add this to stocks, bonds, and cash because it will be perfectly liquid. It will have tremendous upside. You will know what the fundamentals are. You will be able to use technical tools to make decisions. And it will be one of the biggest and most important asset classes, in my opinion. It is not at this point. Okay. Let's just talk about stocks and bonds and cash. And let's talk about the various ways you can take your fiat money, your wealth, your checking account, your savings account, the cash value of your insurance policies, CDs you might have, liquid fiat money, not the things that you can't get to, which we talked about, but the things you can get to and do something with. How can you put that into stocks? Many, many ways. You can open up an account yourself on E-Trade or on Charles Schwab, which is a discount broker, or 50 other discount brokers. You don't need to talk to a broker. You don't not need to have anybody giving you opinions. You can make your own opinions. If you think you love Tesla and you've got a reason to do it and you want to put money in it, you can do it very easily electronically from your home. And now you own, let's say your total wealth is $100,000 after X minus Y. And you decide that Tesla stock is going to the moon. And you decide you're going to put your whole $100,000 in Tesla stock. That is foolish. Putting all of your money into Bitcoin, that is foolish. Foolish meaning you have just turned the potential of money sitting in fiat into something with very variable risk and rewards over time. And you've convinced yourself that you know everything there is to know about this company Tesla, and by gosh, there's no way you're going to be wrong. What you should do is you should divide your your total wealth, that $100,000, into pieces. And you should build a pyramid. And that pyramid should have on the bottom of it the most secure thing you can get into without having to worry about the risk of it diminishing. Well, there's a couple of ways of doing that. One is cash. And yes, over a long period of time, cash loses its value. US dollars lose their value, but not over a short period of time, not over 10 years. Not over 5 years, certainly not over 1 year or 6 months. So let's just say that you have that $100,000 and you decide you are going to keep 50% of it in something that will pay you more than you get in a bank or in a savings account or in a CD, but you don't want it to vary in terms of price to any large extent. Well, you can get into short-term bonds. And let's say you do that. You have 25% of it in cash and 25% in short-term bonds. Short-term bonds, let's say, will be 2 years or less in maturity. We're not going to go into the details, but I assure you they are not going to move very much up or down. You're not going to get paid a lot, but you're going to get paid more than you would in checking or savings account, and a whole lot more than if you were sitting in cash, which pays nothing. In fact, in some places, it has a negative balance. In other words, some banks, and even in the United States, they're talking about charging you interest for your deposits instead of paying you for your deposits. Okay, so now you're $100,000. You've got $25,000 into cash, fiat money, or money market funds, or very short-term bonds, along with 25%, a little bit longer in bonds. Now you've got a strong base. And now let's say you want to put another 50% in very diversified stocks and bonds, like in an ETF or a mutual fund. And that leaves 25% that you can put into individual stocks that either a broker will tell you about, that you'll read about doing your own research, or you turn it over to someone who that's all they do, is they manage money for people on a fiduciary basis. And you say, with this 25% of my wealth, I would like a professional to do it. What are you going to charge? And what can I expect? And what is your past performance? And you can evaluate all of that and decide if that's what you want to do. In that 25% or $25,000, you don't want to put all of that into Tesla stock. The general rule is for large ERISA pension funds, most corporate pension funds, municipal pension funds, U.S. government pension funds for employees, military, and the rest, is no more than 5% into any one security. And that's really pushing the envelope. Because no matter how good a security is, how strong their competitive relationship with other companies are, how good their products and services are, how cheap they are selling at PE ratios and all the rest, I can give you 100 stories of people that became married to a particular stock and had too much of it, and it turned into a disaster, and sometimes very, very quickly. And that is almost impossible to detect with fundamental or technical analysis. It's almost happenstance. My mother, for example, became enamored with Google stock. That's because my sister had become enamored with Google stock and had made a ton of money in it. But I was handling my mother's account, and she called me up and said she'd like to put X amount of dollars into Google stock. And I thought X was too big for what her portfolio looked like, and I told her so. And I gave her the reasons, fundamental and technical, that I didn't think this was a good time to do that. But she went ahead and did it anyway. And she ended up paying $730 per share for it at the time, which was the highest it had ever traded. And 5 years later, she had not made a penny, because Google did not go up from that. It went all the way down into the 400s and spent a long time there. Great company, great stock, great reports, great earnings, great prospects, great everything else. A wasted 5 years. And she wasn't in a position to listen to how you go about selling a position that you love when things begin to deteriorate technically or fundamentally for a period of time and then re-enter at a later time. Because I was doing that for her with all of the other money. It's just this, and she did a couple of other things that worked out nicely. Southwest Airlines, she kept beating me over the head. She loved it. That's the only thing she would fly. She loved what they stood for. She loved this, she loved that. And she was right, and it did terrifically well, beat out many of the other airlines for many, many years, and she did well. So this isn't a criticism of her. It's a criticism of the thinking that goes into making these decisions. Okay, so there's only 3 asset classes that you should be considering if you're considering doing stuff with your wealth. Other than the home that you have, because you know you are going to live in it, and therefore the investment side of it is less important. Now, when you decide to speculate on real estate, a second or a third or a fourth place, timing comes into it. But remember that with real estate, when things are hot, it gets to be very liquid, and when things are cold, it gets to be very illiquid. And the differential between the bid and the ask in a hot market and a bid and the ask in a cold market is almost in a different universe. And that can happen very quickly. It usually doesn't. The real estate cycle tends to be very long, but everybody remembers what can happen in 07, 08, and 09. And a lot of places are just getting back to what the original values were 15 years ago, 14 years ago. Okay. So that's just a general way of looking at all of these things. So when you write in with a question about, should I buy the NASDAQ? There's no way to answer that. First of all, there's no way we are going to answer that, because it depends on who you are, and it depends on what you have in Y, and how the rest of Y is already invested. So what that means is, if you want to tap in to a specific relationship in which you ask questions and get answers that come in the form of advice, there's ways of doing that. And Leah and I are trying to make what we are doing more readily available for that type of relationship, where we can get into details in terms of answering specific questions about specific things. You've probably all read all of the disclaimers that we have, that almost everybody else has, and part of that is legal. In the crypto space, nobody knows what is legal and what is not legal until our regulators begin issuing rules. But to get in front of those rules, the smartest thing to do is don't give any advice on shows like this. Simply teach what we know to be true, and we can tell you what we are doing or thinking and how we came to those conclusions. But turning that relationship around, where we are being asked specific questions of should I or shouldn't I, doesn't make any sense. Okay, so how do you get that information? Okay, you can start by doing a lot of reading. Now, here's the funny thing about the investment world. Unless you are a professional investor, you've got another job. You're a doctor, you're a lawyer, you're a CPA, you're a mechanic, you're a teacher, you're any one of a million different things that takes up hours and hours and hours of your day. But more importantly, it takes up your attention and your focus, and it takes up your emotions, and you get tired. And the last thing in the world you want to do is then go through a whole process of the type of thing I'm describing. So you can do 5 or 6 things. You can find a newsletter writer who's got a long track record and is very precise on how they say what they say to give advice to people that subscribe to that newsletter. And they can run from, you know, $99 a year to $250,000 a year. In the company that I was in, we subscribed to two that were $100,000 to $250,000 a year, and they were worth every penny of it. So there's a tremendous range of expertise that by writing out a check, you can get on a daily, a weekly, a monthly, a quarterly basis, very strong thinking about investing and investments and where you should be according to this person. It takes a while to get to know that person and their performance, and when they get into trouble, what they do, and do they overstate things, and all of that sort of thing. There are hundreds and hundreds and hundreds and hundreds of those out there, and some of them are very, very good. Okay, if you don't want to do that, you can get a lot of great free advice on a number of things on the internet, hundreds and hundreds of places. And maybe at some point, Leah and I will come out with a list of newsletters and websites that I have used over the years that I would recommend. Some of them cost money, some of them don't. Now, you're still not talking to anyone. You're doing your own research. That takes time. You've got to read those letters. So many of them are, you know, telling you that this thing is going to go up 1,000% or 2,000 or 5,000, or here's a particular thing that this guy living in Reno, Nevada discovered by accident, and every time he's used it, you know, it's turned into a gold mine. Very difficult to separate all that out. It takes a lot of work and patience to go through that process, but you can do it. Let's talk about establishing a relationship with another human being. There are things called brokers. They're called registered reps. They're called brokers. They're called clients, client men. They've gone by a number of names over the years, but it basically means somebody that works at a quote unquote brokerage firm and gets paid when you give them some money, and that money stays in the brokerage firm in your account. And from time to time, you can call them up and say, I think I would like to buy Tesla. And they will say, yeah, that's probably a good idea, or no, that's not a good idea. Here's the pros, here's the cons. But it's your decision. After receiving that information from the broker has not yet been paid. You've simply opened up an account. The broker will get paid if you decide that you are going to buy that Tesla stock. They will get paid a commission, about anywhere from 35% of it to 50% will be paid to them. The rest will go to the brokerage firm. If you sit there with $100,000 in your account for a year and don't make any trades, the broker does not make a penny. Well, brokers know that. So brokers go through a very intensive training on how to sell securities. In fact, that's basically what they learn. Yep, they take a bunch of tests, Series 7, Series 23, 24, all kinds of regulatory tests that they have to study for. And after they get licensed, they are now a broker. And basically, they've memorized a bunch of answers to questions. So you have to determine how long has this person been doing this, and get to know them and understand their experience and all of that. You've got to get to the point where when they call you up and say, look, I've got a great idea. IBM is beginning to do X, Y, and Z, and we think it's kind of cheap, and here's a research report that our people wrote, I think you should put $5,000 into it. Still, you don't have to do that. They have to convince you to do that, and if they do, they get paid a commission. Now, let's say they've convinced you to put all $100,000 into various stocks and bonds and other things. They've been paid for each one of those. And now your understanding was that that's going to be a great portfolio and you're going to sit on it for the next 5 years. If you do that, that broker is not going to make another penny off of you. So from time to time, you will get a call saying, you know, that Tesla that we bought, we paid $370 and it's now down to $280. Did not work out so well. I think you should get out of it, and maybe we'll get back into it later, but here's a better idea. So you get out of a position, he gets paid a commission. You get into his new suggestion, he gets paid a commission. And now you've got all your money back invested again. And so it goes. So you're put in the very difficult position of making the decision, is this person making these comments to me to make a commission, or is he doing it for my financial welfare? Tough call. Especially when you look at things like the Wolf of Wall Street. Now, those are illegitimate brokers. Most brokers are not illegitimate. They are not fraudulent. They are not running scams. But there are a lot that are. There's whole companies that do that. And sooner or later, they get into a lot of trouble, and a lot of people are fired, and big fines are paid. The people that had invested their money will not get it back. And they will go to other places, and they will get other jobs, and they will be back on the phone again trying to open up companies or accounts. So that's one way of doing it. And I started as a broker. My first 5 years was as a broker at Dean Witter, then at Shearson American Express, Lowbro's Hornblower, all great companies that tended to get bought out by other companies over time. And most of the brokers that I met, hundreds and hundreds and hundreds of them, were very high quality and were really looking out for clients. But every office that I went to, there was always one or two or three or four that everybody had their eyes on and couldn't believe what was going on. And that was in the great companies. And again, there's a huge spectrum. Okay, that's what a broker does. Brokers are not money managers. Brokers are not financial planners. Brokers are not certified financial analysts. Brokers are salesmen. And 95% of all the people in the financial world, there's about 550,000 are brokers, salesmen. Okay, the next group are money managers. Money managers don't get paid a commission. They're not allowed to, because they take fiduciary responsibility over your assets. They take that fiduciary responsibility away from you. A broker does not do that. You have it with the broker, so they must persuade you to take action. But with a money manager is paid a percentage of your assets as a fee. On very large accounts, it drops down to about 35 basis points a year, or 1/3 of 1%. By very large accounts, I mean the kind of accounts that I managed for 20 years that are called institutional accounts, where our average account size was $20 million, and our large accounts were $100 to $400 million, and our small accounts were $5 million up to $20 million. Those accounts negotiate the fees from about 1%, which is standard. Anything more than 1% for an asset manager is over the top, in my opinion. But 1% is a reasonable fee. So on $100,000 account, you will pay a money manager $1,000 for that year to manage your money for you, making all the decisions, not discussing with you why they're buying, why they're selling, what they're buying, what they're selling, simply doing it. And you have to evaluate how good they are at what they say they do. And it's difficult to do. You can look at performance numbers and that sort of thing, but the best way is look at experience, how long they've been doing it, what kind of companies they've worked for, who their former clients are. That's a good starting point. So that's the second way to get involved with a person if you don't have the time to do it yourself. There are a number of other ways. Vanguard and John Bogle have been saying for years, the way to do it is simply, everybody can do it themselves, simply by buying an index. So when we're talking stocks, bonds, and cash, you can get away with basically buying about 6 index funds that cost literally no money at all to get into or out of. Their management fees are unbelievably low, down around 10 basis points, 0.1% per year. And what they own is they own every stock in an index. Like the S&P 500, they own all 500 stocks. And since the S&P is a known item, meaning you can track it going back to 1926 when it started, you make the assumption, well, it's done well 10% per year since 1926. All I've got to do is put $50,000 of my $100,000 into an S&P index fund. And that's perfectly correct. And you are very diversified. You own 500 stocks, big stocks, little stocks, in every category: finance, technology, utilities, consumer durables, energy. It's all in there. And you don't have to do a thing. And that's what it means to buy an index fund. To me, that's one of the stupidest things anybody can do. And I know it's being a heretic to make that comment. But the reason I make that comment is because what we've seen over the last 15 years, it's true that the S&P 500 has gone up on average 10% per year since 1926. But it's also true that from 1929 to 1953, the stock market did not go up at all. 1929 to 1953. 1929, the market peaked at 388 on the Dow. 1953, it was still 388. Never went higher over that entire span of time, and for very long periods of times, it went much lower. It got down to 44 at one point from 388. If you were an index fund, you would have had zero return, but you probably would have been scared out over and over again over that 23-year period and simply gotten out and taken big losses. The stock market did not go up at all from 1965 to 1982, 17 years, almost a generation. Your kids were born in 1965. You put all your money into the Dow or the S&P 500. 17 years later, the kid's gone off to college. You have exactly the same amount of money as you did 17 years earlier. How is that possible? Well, it's possible because we were talking about averages of 10% per year, and markets don't give you 10% per year. They average 10% per year. They can go for very long periods of time with no growth or with negative growth going 1 year, 2 years, 3 years. 2000 to 2003, the stock market dropped 50%, the NASDAQ dropped 80%. So living through 1920, excuse me, I'm not that old. Living through 2000 to 2003 with large institutional accounts who told me I could not defend their assets. I must stay fully invested. Convinced me of how dumb that approach is. When there are tools available to everybody that Leah and I have been attempting to demonstrate to you, that shows how easy it is to make a determination if a market is moving from a bull market to a bear market. We call it consensio, but there are 50 other ways of doing it. And by looking back at our vlogs, you can see how we're applying it to the crypto market, particularly to Bitcoin. But that is something you can do. And you won't have to worry about it. You can buy it and leave it. You can spread it out between bond funds and stock funds. You don't have to put it all in the S&P 500. You could put it into an index of energy stocks, an index of consumer durables, an index of finance. And from time to time, you might decide you're going to rebalance it using some of the tools we're talking about. So you don't have to be dogmatic in any of these things I'm talking about. You can be flexible. And that's what I'm trying to show, is the flexibility is important on your part. But you, the one I am now talking to, not the other 5,000 that are going to hear this, just you have to decide what is comfortable for you, what you are looking for, what alternatives you have, without going through the process of everything I just said through experimentation. And you can do that by talking to tax people, your accountant, if they have some sort of a background. You can talk to financial planners. You can go to trust departments that take responsibility over these things called trusts, and they have attorneys, they've got CPAs, they've got financial professionals. I taught the classes in New York State to the trust officers in New York State on technical analysis. And there'd be 200 or 300 of them from many, many trust companies sitting and listening to my explanation of why they should be using technical analysis as one of their tools in helping to manage these trust accounts. So you've got a lot of things open to you. And all I'm trying to do tonight is to sort of lay all of those out. But I want to make some points which are my conclusions that I have drawn over this very long career. And we've given you most of those in tweets or in passing in vlogs, in terms of little metaphors or things that I've taken away that have proven to be true over and over again. And number one is liquidity and diversification. I said that stocks, bonds, and cash are liquid. But if you take any one of those, you can find that they can become illiquid. Stocks, bonds, or cash. Cash can become very illiquid if you put it into a CD. Illiquid because if you decide to take the money out, you pay a penalty for it. You might lose a whole quarter's interest. There are some very short-term bond funds that are very illiquid because of the type of things that they buy. Even some commercial paper can become very illiquid, and all of that I consider to be cash. In the stock market, you already know, because you've seen Wolf of Wall Street, that some stocks can be very illiquid. The pink sheets, which are the cheapest of the cheap of the over-the-counter stocks, very rarely trade, are easily manipulated, or often scams, but they are stocks. So just because something calls itself a stock does not mean that it is an investment.
Oh no, Tyler, I think we lost you. Live chat, are you able to hear Ty? Keep going, Ty. We'll see. Okay. Oh, muted. I can't hear. Oh, okay. Well, I think we'll get Tyler back in like a second. No, okay, I got it. No. Probably. All right. Well, I think we're actually probably gonna end this pretty soon. Is there any last questions that you guys have? If you want to throw it my way, and Tone started a cooking channel. That's probably true. Can Tyler see the chat? He cannot. We'll get him back on in a second though. Otherwise, I may just have to end it. Executive decision. Will Tyler's cat be? It was actually his grandson. Okay. Okay. I think that this one's gonna be to be continued. I think that's gonna be the executive decision. Okay, everybody, have a great night. It's 9:50. You should watch the Caps kick Vegas's ass right now, and definitely we'll have another. Thanks for listening to this one. It was definitely just we've been getting a lot of really good questions and comments and everything, and it just we've been talking a lot about how to synthesize just everything that we're hearing. Ooh, Tyler, Ty.
Hi.
Okay, gotcha. I was saying that probably we want to end it pretty soon here. We're going on an hour, almost hour and a half.
Wow, time flies when you're having fun.
Yeah.
We will end it here unless there are some questions, Leah, you want to get to. And what we will do is we will pick up where we left off. I want to go into, after the diversification of what your wealth is into liquid assets, how do you size your positions? And then I want to go into how do you get into them and how do you get out of them? And we'll do that in a vlog very shortly as an addendum to this one.
Awesome. Ty, I think we'll end it on that. So everybody, thank you so much for watching. We're going to start ours back up regularly again, which is going to be very exciting. So have a great night. Ty?
Great. Thank you very much. Talk to you later.
Bye.